Hello everyone, welcome back to our weekly webinar series. My name is Faiza Hashmi. I'm the tax director here at Press Cooper. Today I've been joined by my colleague Mahar Afzal, who is the managing director, and together we will take you through today's webinar. So every week we have been discussing various topics of corporate tax. We have gone through the corporate tax law, we have gone through the different cabinet, ministerial and federal decisions, we have gone through different guides. If you have missed any of our previous lectures, they're available at our YouTube channel. You can always email us if you have any questions at info@presscooper.com. So usually we are recapping our previous lecture, but today, instead of that, I will be discussing the FTA decision number 3 of 2024, which is the timeline, which is giving the timeline for registration. So this has recently come out and there's been a lot of talk about this. A lot of our clients, and I'm sure that you guys as well would have a lot of questions and confusion regarding this registration timelines that has been suddenly given by FTA. So we wanted to take this opportunity to discuss this topic today. So in the corporate tax law, when the corporate tax law had come out, Article 50, which is dealing with tax registration, that said that any taxable person shall register for corporate tax with the authority in the form of manner and within the timeline prescribed by the authority and obtain a tax registration number. So at that time, the timeline was not given, the form and manner was not given. Then we saw that later that the tax registration guide had come out, which explained to you how registration has to be done. And then now with this circular, with this FTA decision, they have now given you the timeline, which is there for registering or getting this tax registration number for your company. So previously, when there was no timeline, the default timeline was taken as any time before filing the first corporate tax return. So now, but because with this change of this new decision, the companies will now have to follow the timelines which are given in this decision. So this decision has bifurcated the type of people. So they have talked about what will be the timeline for resident juridical persons, resident persons. What is the timeline for the non-resident juridical person? What is the timeline for natural person? So we will be discussing that in detail in our slides. So the first category that the decision is talking about is the registration timeline for resident juridical person. Those that have been incorporated before March 1st, 2024. So if a resident juridical person, what is a resident juridical person? We discussed many times before. They need to be resident of the UAE. They need to be a legal person. So they need to have a legal identity separate from their owner, like an LLC company, private company, public joint stock company. So if those companies have already been incorporated before March 1st, 2024, which is the effective date of this decision, they need to follow the timeline in this table. So let's discuss this table a little bit. So now FTA, instead of giving one timeline, so they might have chosen to give one timeline, like maybe 30th June for all companies to register. They chose not to do that. They have spread out this timeline, over the period of this year and the next, and given the chance to the companies also to register, as per this deadline. And also, I think to ensure that there is not too much load on the Mara tax portal or on the tax officers who are reviewing this application. So now the basis that they have taken to spread out this deadline is the date which is in the license of the company. So now two things that are very important to understand here is that this deadline is for submitting a tax registration application. So it is not to obtain the TRN certificate, which means that there is ample time for companies. Right now, even the earliest deadline given is 31st May. So there is 3 months, and that also is to submit a tax registration application. So not for FTA to review the application or to give approval or to give you a TRN. So as long as you are able to submit this application within this timeline, there will not be any repercussions. So if you've seen the bifurcation they have made it according to monthly dates. So the other important thing is that they have not taken the year into consideration. So if one company was registered, let's suppose in January 2023, and one company was registered in January 2020, both of the companies will be treated the same, and they will need to be registered before 31st May 2024. So we need to ignore the year of issuance and we need to see the date on the license. So if now the date on your license is between 1st January to 31st January, the deadline for that company would be 31st May. The same for 1st February to end of February would again be 31st May. So these are the companies that need to be more vigilant and start applying for this registration, because any company which have a date on the license from 1st January to 29th of February needs to add the category which have to given the shortest deadline, which is for 31st May. Then after that, any company who has the date on the license from 1st March to 30th of April, so they need to register by 30th June. Any company that have a date from 1st of May to 30th of June, they need to register from 1st of May to 31st of May, need to register by 31st of July. For 1st June to 30th June, they need to register by 31st August. Then for companies who have a date on the license between 1st July to 31st July, they need to register by 30th September. And companies then from 1st August to 30th September, for these 2 months, need to register by 31st October. Companies from 1st October to 30th November, they need to register by 31st December as well. So you will notice in some of the licenses that there might be a case where 2 dates are appearing. So there might be a issue date, there might be establishment date as well. So we recommend that you should take the earlier date, whatever is the earlier month from these dates. You should take that into consideration at the moment and then register according to that timeline. So there could be also a possibility that a company might have more than one trade license. So you might have an industrial license, you might have a trade license. So in that case, sorry. So in that case, you will also need to take the earliest, date on the license, whichever is earlier from those. You will have to consider that for this. Where a person does not have a license, at the moment at the effective date, they are already incorporated, they don't have a license. So for them, they have also given the date of 31st May to register for this. So just I'm going to highlight important points again, that year of the year on the trade license is irrelevant. Only the month will be taken. This is the deadline for submitting the tax registration application and not to obtain the TRN number. Also, that this rule is applicable on companies which are already incorporated before the effective date, which is March 1st, 2024. So moving on. Apologies. Yeah, 1 minute. Okay, so moving on, they have given a deadline for resident juridical person who will be incorporated after March 1st. So if there is any company who will be incorporated after March 1st, so for them, if they are a free zone person or a mainland entity, and they would be incorporated after this effective date, then the date for deadline is 3 months from the date of incorporation of that company. So if the company is registered under foreign jurisdiction, and that is, they're effectively managed and controlled from the UAE, then the date for them would be 3 months from the end of the financial year of the person. So for example, if the financial year of the company is January 1st to December 31st, 2024, so it would be 3 months from that, but that would be March in 2025. So then we have the second category, which is a non-resident juridical person. So for them also, they have 2 categories. One who are already registered prior to March 1st, 2024, which is the effective date. So if a non-resident person has a permanent establishment in the state, the deadline date has been given as 9 months from the date of existence of the permanent establishment. If the person has a nexus in the state, so then the deadline has been given as 3 months from the effective date of this decision. So here, there is still more clarity that needs to come for the first category, which is a person that has a permanent establishment already in the state before this effective date, because right now the deadline has been given as 9 months from date of existence of the permanent establishment. So this needs more clarity, because this date could be in the past, as it appears right now. If a permanent establishment is already, maybe existed in 2020, let's suppose. So then this needs more clarity from FTA, that what is this deadline that they're giving. Then we have the second category for the non-resident person, which is juridical, which is a non-resident person that comes into effect, that becomes a non-resident person after this registration, after this effective date, which is March 1st, 2024. So if a non-resident person has a permanent establishment after this date, so then it is 6 months from the date of existence of the permanent establishment. Now here this makes sense since this is in the future. A person, if they have a nexus in the state, so it is 3 months from the effective date of whenever the nexus has been established. So another category which has been taken care of in this decision is the natural person. So for the natural person, if a natural person is conducting a business or business activity in the UAE, we know that they need to register if they are crossing the threshold of 1 million of the turnover, then only they need to register. So for a resident person who is conducting any activity during the 2024 Gregorian calendar year, so that is their year, we know that already from the previous guides. So they will need to see that if they're exceeding this threshold of 1 million and they need to register, then they need to register by 31st March of the subsequent Gregorian calendar, meaning that for the 2024 year, they need to register if they're crossing this threshold by 31st March of 2025. So for a non-resident person who is conducting a business or business activity during the 2024 Gregorian calendar, um, and they are crossing this threshold. Right now, the deadline given in this decision is 3 months from the date of meeting the requirement of being subject to tax. So more clarity is again needed on this because, like for the resident person, they have very clearly said that the date is 31st March of the subsequent Gregorian calendar year. But for non-resident, they have written it as 3 months from the date of meeting the requirement. So usually in the law, you need to look at the whole year before you can know that if you're crossing this 1 million. So here it appears that they want a non-resident person to see that if they are crossing this in the middle of the year, if they've already crossed this limit. But again, it is not clear why they have made this distinction between both of them. So more clarity right now is needed for this. So the late registration penalty has also been provided. It is 10,000 if you don't register by this timeline, which has been given, which we just discussed previously. This is in line with the late registration penalty, which you get in if you are late for VAT registration as well. So it's aligned with that right now. And like we said in the start, that if there is any ambiguity, it is better to take the earlier date and to apply for the registration before this 31st May, so that you can avoid this penalty. Now I will hand it over to Mahar, who is going to discuss the topic that we were discussing, which is on the tax group, and he will take you through today's topic.
Hello, everyone. Thank you very much for joining us once again and welcome back. Thank you very much, Faiza, Finally, the deadline, the timeline for the corporate tax registrations have been introduced. But don't get panicked, guys. We have sufficient time. We have still every business who is liable to register. They have still 2 months at least to get themselves registered. Natural person, they need to get themselves registered by 2025, by 31st March 2025. The rest of the 99, majority of the businesses, minimum timeline that they have is 2 months. So and 2 months they are asking submit the application. They are not asking that we need to get the tax registration certificates within 2 months from the FTA. FTA is asking the decision. It has been mentioned in the decision that we need to apply for registration. Anyway, we have sufficient time. We'll sort it out. So we are discussing today, the next important topic is tax group adjustment regarding net interest expenses in the occurrence order. What the law says basically whatever are your interest expenses, it needs to be adjusted against the taxable profits in the order in which these net interest expenditures were incurred. So what is first of all net interest? We all know this net interest expenditures are basically net of income and net of expenses. We have already discussed in detail. I will not put too much time on. Basically, you can say interest income, interest expenses. If the interest expenses are higher than the interest income, it will be considered net interest expenditures. If the net interest, so if my interest expenses are higher than the interest income, so I will say I have the net interest expenditures. For the net interest expenditure, we have already discussed. Whatever we have discussed basically are the individual taxable persons. They all were discussed, that the law allows that a taxable person can claim 30% of the adjusted EBITDA or 12 million, whichever is higher. So law gives me an option that I can adjust up to 30% of the adjusted EBITDA, 30% or 12 million, whichever is higher, I can claim during the current tax period. Remaining will be carried forward for further period of 10 years, for the tax period of 10 years. So adjusted EBITDA, we have already discussed this. Adjusted EBITDA is equal to EBITDA less exempt income. Whatever is remaining, it will be adjusted EBITDA. Exempt income will not be considered in the EBITDA calculation. Adjusted EBITDA and related expenses, related income, related expenses will not be considered while calculating the taxable profit related to the exempt income. So this was the general principle. General principle is that the taxable person can claim 30% of EBITDA, 30% of adjusted EBITDA or 12 million dirham, whichever is higher, they can claim, and remaining in net interest expenditure will be carried forward for further tax period of 10 years. This was the general principle. There were some exceptions as well that were discussed. This will not be applicable to the natural person. It will not be applicable qualifying infrastructure project. It will not be applicable for the loan that were taken before, I think 9th of December 2022, and there are no changes in the term and conditions of the loan. So this general principle will not be applicable to those areas. This is the general principle. Now I wanted to apply the same principle on the tax group. Once we applying the same principle on the tax group itself is a single taxable person. There will be multiple entities, but overall this is a single taxable person. Once the tax group is a single taxable person, the same rule will be replicated, will be applied on the tax group as well. So on overall basis, 30% of the EBITDA of the 30% of the adjusted EBITDA of the tax group are 12 million dirham of net interest expenditure, whichever is higher, it will be allowed to the tax group, and remaining will be carried forward by the tax group for further period of 10 tax period. So this is the general law. This will be applicable on the tax group as well. As I mentioned, tax group is a single taxable person. The same general rule will be applicable to the tax group. There is a possibility. Important thing is this is the tax group. There is a 1 member, 2nd member, 3rd member, 4 member. Tax group 30% or 12 million, whichever is higher. If there is a possibility that these members of the tax group has net interest expenditures lesser amount, higher amount, or income lesser amount, higher amount, or this individual, whatever is the status of individual members, it will not have any impact on this general rule. So this general rule will be applied on overall group. It doesn't matter what is the individual, basically what is the taxable income, what is the interest of individual members, what are the net interest expenditures of the individual members, and whatever the adjusted EBITDA of the individual member, it doesn't matter. We should not consider, while applying this general principle on the group level in the tax group, we should not consider what is the status of EBITDA, net interest, taxable profits of the individual members of the tax group, but we need to apply this rule on overall at the group level. This is the group, and we need to apply this rule at the group level. So even if the group members have sufficient EBITDA to offset the net, we should not consider. If the group doesn't have sufficient EBITDA, then we need to have the concerns regarding this. We need to apply the general principle as I mentioned. This 30% condition will not be applicable if the net interest expenses of the groups are less than 12 million. If less than 12 million, the group will claim straightforward 12 million. This 30% condition will come whenever the net interest expenditures of the group are more than 12 million. Once these are more than 12 million, then 30% of EBITDA 12 million, whichever is higher, we need to apply this principle. The net interest, now this is a group. This group might be the 4 subsidiaries. One subsidiary is leaving, another is joining. There is a possibility, or there is a possibility the group member, there is a one person was the tax group members, now group member is being changed. So what the law says? Law says if any subsidiary is leaving the tax group, so the net interest expenses of the group will remain with the group. If any net interest expenses are there of the subsidiary before joining the tax group, so basically these are pre-grouping net interest expenses. Pre-grouping net interest expenses unutilized. I'm repeating, unutilized pre-grouping net interest expenses will be carried forward by the subsidiary. Other than this, unutilized net interest expenses will remain with the group. Now there is a possibility one subsidiary is joining the tax group. Once the subsidiary is joining the tax group, then these net interest expenses these net interest expenses of the subsidiary that is joining the tax group, their net interest expenses will be adjusted. But the two conditions, these net interest expenses, it can be adjusted maximum 30% of the EBITDA of the group or actual taxable income of the subsidiary, whichever is higher. So two things we have discussed: subsidiary is leaving the tax group, subsidiary is joining the tax group. Once the subsidiary is leaving the tax group, the net interest expenses of the subsidiary will be carried forward. Unutilized net interest expenses of the subsidiary will be carried forward by the subsidiary. Group net interest expenses will remain with the group. If any subsidiary is joining the tax group, once the subsidiary is joining the tax group, then the net interest expenses of the subsidiary will be adjusted against the taxable income, against the maximum capacity rule. Based upon the rule, maximum 30% or 12 million, whichever is high, it will be adjusted against them. But the rule is it can be adjusted maximum up to 30% of the EBITDA or actual taxable income of the subsidiary. Now, if that one member was parent company, the change in parent company, if there is a change in the parent company, the new parent company will be leading the group, and that group net interest expenses will remain with the group. Now there is another possibility that group is being dissolved. If the group is being dissolved and parent company will be continuing as a company, as a taxable person, then the net interest expenses will be carried forward by the parent company. If the group has been dissolved and the parent company is not continuing as a taxable person, then the net interest expenses of the group will be forfeited. So these are the some conditions. Basically, if subsidiary is joining, what will be the treatment? If the tax group is dissolved, basically there are two possibilities. Parent company will be working as a taxable person. Parent company is not working as a taxable person. If working, it will be carried forward by the parent company. If not working, it will become forfeited. It will not be the, it will remain unutilized throughout the life. So in basically interest expenses, legal successes, as I told you, there's a one parent company now, another parent company has come, group will continue. If there was one parent company earlier, new parent company is taking over the group, so the net interest expenses will be carried forward by the group. If the parent company ceases to exist, then expenses, net interest expenses will cease, it will be forfeited. Restricted group losses, there is no concept of restricted. Now, this is very important discussion from here. Very important, very honestly. We have discussed while discussing. Let me add one slide here. I think Discord. Okay. Okay, while discussing the losses, we have discussed 5 types of losses. There were 5 types of losses. The 5 types of losses, okay, it was one of them was pre-grouping, second was restricted tax group tax losses, then it was unrestricted tax group tax losses, then it was transferred losses, then there was losses taken through the restructuring relief. So pre-grouping, restricted, unrestricted, transferred under the going concern, basically restructuring relief. These were the when we were discussing the losses of the tax group. Now we are discussing net interest expenses of the tax group. First of all, the most important thing, there is no concept of restricted net interest expenses. We know what is the restricted net interest expenses. These are the net interest expenses before joining of the subsidiary. Basically, these are the net interest expenses of the existing tax group before joining of the subsidiary. There is no concept of restricted tax group net interest expenses. There is no concept of transferred net interest expenses. There is no concept of net interest expenses taken under the restructuring relief. So if the business is being transferred under restructuring relief, the net interest expenses will remain with the transferor. If the transferor will exist as a taxable person, transferor will be able to adjust its net interest expenses over the period of 10 tax period from the end of the tax period when it was incurred. If there is a transfer, if basically one taxable person is can transfer its losses from one taxable person to another taxable person subject to fulfillment of condition, but there is no concept of transferring the net interest expenses from the one taxable person to the other taxable person. Restricted, there are no concept. Now there are 2 types basically, pre-grouping net interest expenses, and they have, you can say this is the one they are using the word, guide is using the word basically, this is the tax group net interest expenses. There are 2 types of net interest expenses: pre-grouping net interest expenses, tax group net interest expenses. There are 2 types of net interest expenses at the group level. Now we'll look on the rules. Rules are basically the same as I discussed. 30% of EBITDA or 12 million, whichever is higher. And the law says net interest expenses will be adjusted in the order of its occurrence. So whatever has incurred first, it will be adjusted first. It doesn't matter the pre-grouping net interest expenses has incurred first, or the group net interest expenses has incurred first, or this area before the joining of the subsidiary net interest expenses are incurred first. So whatever the net interest expense has incurred first, it will be adjusted first, and remaining will be carried forward for further period of 10 years. So this is the important thing. Rest everything is very straightforward, very simple. So there's no concept of restricted tax group net interest expenses. There's no concept of transfer. There's no concept of restructuring. The net interest expenses will be offset in its occurrence, basically in the occurrence order. Whichever has incurred first, it will be adjusted first. Important thing is here, one more thing. If there are multiple net interest expenses related to A, B, C, D, different entities, and all the entities have the same ending period, so either you are adjusting A first or B first, it doesn't matter. Taxable person, including the tax group, cannot transfer its net interest expenses that we have already discussed. The net interest expenditure will remain with the transferor. If the transferor ceases to exist, unutilized net interest expenditure will be forfeited. This is very straightforward. We've already discussed this. So impact of tax group. This is not applicable, as I discussed, this is not applicable on banks. This will not be applicable. This general rule is not applicable on the banks, insurance companies. So banks will be able to claim 100% interest. There are no limitation of 30% of EBITDA. There are no limitation of 12 million. 100% interest bank infrastructure project. The companies which are involved facilitating qualifying infrastructure project. The qualifying infrastructure projects are basically, this is related to, you can go to specific decision, this is related to the health, education, welfare. So if any entity is in or supporting the qualifying infrastructure project, rule will not be applicable there as well. So if the loan has been taken before 9th of December 2022 and there are no changes in the terms and conditions of the loan, this rule will not be applicable on that. So net interest, this will not be applicable on the natural person. We know this natural person cannot become a part of the tax group, but still rule will not be applicable even this is a single taxable person. So whatever we have discussed, there is one example. This example has been given in the guide provided by the FTA, Federal Tax Authority. We'll look into this example. They said on 1st of January 2026, company A holds all the shares in company B. A holding the shares in company B, C, and D. E is at the top of it. A is here. Then this is the B. This is the C. This is the D. Here is the A. Okay. All four companies during a calendar year as their tax period and meet all the requirement to form a tax group. On 1st of January 2026, company A forms a tax group with the B, C, D. They are entered into a tax group. A, B, C, D. 1st of January 2026. Company A forms a tax group. Okay. Tax group's EBITDA in 200 million and tax group net interest expenditure for the tax period is 38 million. So net interest expenditure, two things are very important. Net interest expenditure 38 million, EBITDA is 200 million. Further, company BCD having the following pre-grouping net interest expenditures. Pre-grouping net interest expenditure, we have already discussed the rules. It can be adjusted maximum up to 30% of the EBITDA of the group, or whatever the actual taxable income, whichever is lower, they can be adjusted. So in 2026, the taxable income, the group taxable income is 42 million, which can be attributed as follows. Company A, 2 million, B, 30 million, C, 14 million, and D has losses. So just keep in mind, this is very important. D has losses. Taxable income of A, B, and C, 2, 30, 14 million. Why this is important? Because while adjusting the pre-grouping net interest expenses, we need to look into this 30% of the EBITDA, maximum 30% of the EBITDA, or actual taxable income of the respective subsidiary, whichever is higher. So we will be comparing these numbers with their net interest expenses, pre-grouping net interest expenses. This is the reason this is relevant. So I have summarized this example into a straightforward this table 2024, 25, 26, 26. Okay. In 26, pre-grouping net interest expenses 10 million, 5 million, 7 million. 25, 5 million, 5 million, 5 million. 26, this is the actual taxable income of the group individual mind, how we have attributed 2, 30, 14, and 4 million losses. Overall, this is 42 million. ABCD, this is adjusted EBITDA. This is not ABCD, this is net interest basically. Net interest. This is example. Now sticking to the rule. Rule is 30% of EBITDA. 30% of EBITDA or 12 million, whichever is higher. EBITDA is 200. 200 million multiply 30%, 60 million. 60 million or 12 million, higher is 60 million. So In 2026, maximum interest that can be adjusted is 60 million. Remaining will be carried forward for the period of 10 years. So 60 million, out of the 60 million, first of all, the tax group needs to adjust the current period net interest expenses. How much is the current period net interest expenses? These are 38 million. So 60 million less 38 million, it will be 22 million. 22 million is available to adjust the pre-grouping net interest expenses. Repeating, 22 million is available to adjust the pre-grouping net interest expenses. And first of all, we need to adjust 2024 because losses, we need to adjust the net interest expenses in the occurrence order. First, 2024 has occurred, we need to adjust 2024, then we need to adjust 2025. Important thing, another A, B, C, D, they have the same tax period, ending with the same tax period. So either you are adjusting B first, C first, or D first, it doesn't matter. In the same way, this is for the same period, either you are adjusting B first, C first, or D first, it doesn't matter. So out of this 22 million, first of all, we will adjust B, C, D. While adjusting the B, C, D, important thing, and this is important, while adjusting the B, C, D, you need to look into this 30% of the EBITDA maximum 30% of EBITDA, remaining is 22 million, we can go up to 22 million, or their taxable income in the current tax period, whichever is lower. So this 10 million, so this 10 million or 2 million, sorry, or 30 million, 10 million or 30 million, whichever is lower, 10. So 10 will be adjusted. Then remaining will be 12 million. 22 million less 10 million, 12 million. Then next, I think this is the 5 million, right? 5 million. Yeah, 5 million. So next 5 million, 5 million. 5 million or 14 million. Lesser is 5 million. So 5 million further will be adjusted. Remaining will be 7 million. Then D, 7 million or 4 million. 4 million lesser, so zero adjustment. So now we have 7 million. Pre-grouping net interest expenses of 2024 has been adjusted. Still we have 7 million. Now we will move ahead. We will adjust 2025. 2025 pre-grouping net interest expenses, we need to adjust it. For the pre-grouping net interest expenses, 7 million, we need to adjust 7 million. So 5 million. So 5 million, this is my 5 million, or remaining is, now first you are adjusting B first or C first. It all up to you, because D you cannot adjust. D has losses. D doesn't have taxable income, so D cannot, you cannot adjust. So you can adjust B or C pre-grouping losses. So B or C pre-grouping losses, you can adjust it. And how much that taxable income has been utilized? Their taxable income has been utilized already 5 million. Remaining will be 25 million. Here it has been adjusted, utilized already 7 million. Remaining will be 7 million taxable income. 25 million, 7 million is the remaining taxable income. So 5 million or 25 million, whichever is lower, 5 million. So we have 7 million remaining, 7 minus 5, 2 million. Still remaining, you can adjust. C is a 5 million. So 5 million or 7 million, again 5 million. You can adjust maximum 2 million, remaining will be 3 million. So carry forward net interest expenditures will be, carry forward net interest expenditure will be, assuming this has been adjusted, this is remaining 3 million, this amount and this amount. So vice versa, you can adjust B first, sorry, C first, then B will be carry forward. So just look into this. So first of all, rule is 75% of taxable income of the group. From where this 75% point? Okay, this is criteria 75% of taxable. No, this is not 75%, 30% of the taxable income of the tax group. So 30% of the EBITDA. So this is the rule. This is ignore it. Maximum 30% of EBITDA, 12 million, whichever is higher. Subsidiary must have taxable income. And for the group, so I have classified this is the group. Again, this is the 1, 2, 3, 4, 5. This, and this. These are not applicable. They have been consolidated. This and this has been consolidated. The rule is same. Here, there is no restriction of income. Here, there is restriction of income. So the maximum is 60 million, less 38 million, remaining is 12 million. We have already discussed. Important thing is, even the group has not sufficient taxable income, still this 22 million will be adjusted and the tax losses will be carried forward for unlimited period of time. This is the important thing. This 22 million will be adjusted in the current tax period. This will be adjusted in the current tax period. If the group has the losses will be carried forward for further unlimited period of time. Net interest remaining will be carried forward for 10-year, losses unlimited period of time. So this is pre-grouping losses adjustment against the 22 million as we discussed earlier. So 10 million, 5 million total available was 22 million, 10 million adjusted, remaining is 12 million, 5 million adjusted, remaining is 7 million. So 7 million D, we cannot adjust, D has the losses. So 7 million has been adjusted 2 million. We have already discussed this. So 2 million and remaining. So carry forward losses will be, this 2 million will be remaining carry forward losses. D will be losses carry forward because D doesn't have a taxable income. Since you can, same way, it has been adjusted. We have adjusted B first. Here you can adjust the C first as well because both are ending on the same tax period. I think rest things are very simple in this lecture. Important things are couple of things are very important. One thing is 30% of EBITDA or 12 million, whichever is higher. First, we need to adjust the current period net interest expenses. Then we need to adjust the pre-grouping net interest expenses. For the pre-grouping, subsidiary must have the taxable income. Again, this is one important, subsidiary must have the taxable income. Another important thing is maximum up to the capacity of the net interest expenses, which is 60 million, current 38 million, remaining 22 million. This 60 million will be adjusted in the current tax period. It doesn't matter, the group will have a taxable loss. If it will be a taxable loss, losses will be carried forward for unlimited period of time. You cannot say that the group doesn't have the taxable income, we cannot adjust the 60 million. No. Law is not asking the sufficiency of the taxable income of the tax group. Law is asking sufficiency of the taxable income of the subsidiary that has joined the tax group. So sufficiency of the taxable clause is not applicable on the tax group. So thank you very much. This is over from our side. You can contact us. Registration has been opened. If you have any query regarding the registration, if you have any query regarding the impact assessment, implementations, we are always here to support you. You can contact us info@crestcooper.com, or you can give us a call. Thank you very much. Thank you very much for being with us. So if you have any question, you are most welcome. I think two questions were there. See all, Faiza, she has already answered. So if any question, you are most welcome. Okay, guys, thank you very much and have a lovely evening. Thank you. Bye-bye.
Thank you, everyone.
Thank you very much. Thank you. Bye-bye.